ETFs. The moderator is Mo Sparks, and I'll let him take over.
Thank you very much, Jim, and it's a pleasure to see everyone this afternoon, or I guess I should probably technically stay till the morning. I recognize that we're the last panel really before lunch, but I'm excited to have an exceptional group of folks here today to talk to you all about how actively managed ETFs are accelerating. So, Mo Sparks, I really lead and manage actively managed strategies at the New York Stock Exchange, and so building out the platform to support the great people we have here today, and so I have the privilege of working with many of them, and an honor to moderate. And so we're going to kind of structure our conversation in a few different areas. We're going to talk about the state of the market today and some of the things that are happening from a trend perspective. Then we're going to dive a little bit into how each of these firms kind of thought about product design, and then we'll kind of finish around things that they're hearing from clients, and obviously we want to hear questions from you all kind of as we go through. So with that, I'm actually going to allow each of them to introduce themselves because they'll naturally do a much better job than I will, and we'll actually start here with Chris Murphy.
Thanks, Mo. Thank you for being here today. My name is Chris Murphy. I am a ETF specialist with T. Rowe Price. We're fairly new to the ETF industry, launching our first products in August of 2020. We have 8 products in market today. I grew up in the ETF business, starting my first job out of school at State Street. So the ETF business is near and dear to my heart, and I've been lucky to see the growth and look forward to speaking today about this new generation of active ETFs.
Good morning, everyone. Whoa. I was very excited to have a handheld, so it feels great. Scott Sever. I work at Capital Group. I support our ETF capital markets. We just launched our first suite of products February 24th. You probably know why that day was kind of important and pretty exciting day to launch an ETF. But we launched 6 products, all active, transparent. Prior to being at Capital Group, I worked at the New York Stock Exchange, supporting exchange-traded products, and Vanguard for about 14 years prior to that.
Hello, everyone. My name is SHANA, ORCZYK, SISSEL. I am with a multifamily office in D.C. called Corrales. I'm sort of one of these things is not like the others on this panel in many ways, not just because I'm a woman and I'm surrounded by a bunch of men, but also because I'm a practitioner and allocator, but I also was a consultant in the launch of an active ETF for a firm called Armada ETFs, launched a actively managed residential REIT ETF. So I bring a couple of different perspectives as both someone who has reviewed ETFs for a model provider during my time at Orion Advisor Solutions and Fidelity Strategic Advisors, as well as having been part of the launch of a product and now allocating again to ETFs through proprietary models at Corrales.
Hello, everyone. I'm Michael Giuliano. I'm on the product team at Putnam Investments. So we are new to the ETF market. As of last May, we have 4 semi-transparent, actively managed equity ETFs. Hopefully a lot more to come, but excited to be here today.
Perfect. Well, exceptional. So as I said, we're actually going to start with a little bit of a conversation around the state of the market today and kind of how we got there. And so, Chris, I'm actually going to start with you. Obviously, this industry came meaningfully directionally from 2007 when Bear Stearns actually was the first issuer of an actively managed ETF. Rest in peace, obviously. We're now at roughly 900 active ETFs with about $300 billion in assets. The growth in particular over the last few years has been remarkable. So I'd love to hear your thoughts, kind of how you see the market evolving and what do you see on the future?
Sure. When I think about the current state of the active ETF market, I really think of it as a really interesting dynamic and inflection point of supply and demand, right? So meeting the demand of the investor with this really new wave of supply that's currently hitting the market and the maturity of the market, right? So as you mentioned, active ETFs, a little over $300 billion in assets, over 600, maybe even 700 products now in market, pretty evenly split, which is a very stark comparison to the passive side. So about 43% in equity ETFs, 47% or so in fixed income. So a good diversification of products and access to categories in the active ETF space. So good demand, good supply there that's hitting the market. Still yet only 4% of the overall ETF market. But when you think about projections of the ETF market and sitting at 4%, projections of 26 trillion I saw from BBH the other day of the overall ETF market. You expect the active ETF market that's accelerating at a higher pace than the passive market from new products from an AUM perspective to really take up a larger percentage of that 26 potentially one day. So a ton of supply, new issuers coming to market, right? So think about Putnam, think about T. Rowe Price, think about Capital Group, very well-established, well-experienced, well-respected asset managers now entering the ETF market, supplying the market with new products, with existing flagship strategies that investors have come to know. Now meeting the demand, right? You see from Cerulli, the attributes of ETFs that advisors are looking at has shifted over time, right? You've gone from fees and maybe expenses to now investors looking at performance as an attribute that is becoming more important to them when choosing an ETF. You also look at BBH and seeing what the adoption is, right? When they surveyed their respondents, they're saying most likely 86% will buy an actively managed ETF over the next 2 or 3 years. So you've got this supply that's been built, maturity that's been built in the market, meeting the demand side of advisors and even institutions, as we heard from our previous panel, looking at actively managed ETFs as a solution. So a really interesting inflection point in the industry that I think is really exciting to be a part of, and nowhere to be known where it goes from here. So really interesting inflection point.
Yeah, I love that analogy of supply and demand. I think, sitting at the exchange and seeing ETFs come through, you referenced some of the stats, but a few that I would just share that we've observed, right, is we've seen this year alone 20 new active ETF entrants, right? So new issuers coming to the market for the first time, 20 so far this year. We've also seen for back-to-back years, we're north of 65% of new products launched are actively managed strategies, right? So the supply is there. And then on the demand side, I could even share just in the month of April, right, for the first time in really a number of years, you saw outflows from broader ETFs. You actually saw another month of inflows into active ETFs. So demand continuing to really be there. So maybe Scott, you kind of think about things a little bit differently, I think, across the board. You and I know each other obviously very well, having worked together a few different times. But would love to hear your perspective on, with Capital Group just kind of entering the market, what do you see as those growth drivers, and why now for Capital Group?
Yeah, so I think you touched on it. And again, there's a lot of products coming to market, a lot of new issuers over the last year coming to market, but it still represents about 4% of the total AUM in ETFs. So, but why do we see a lot of entrants now? Why is it now picking up? I think that was part of our consideration from a Capital Group perspective. We always wanted to bring ETFs to market. We found that this was a vehicle that our advisor community was asking us to provide. That's, as we get into what drove our products that we have in market today, that's coming directly from that advisor community. So we always had that desire to bring this vehicle to market, but from a regulatory standpoint, we didn't find it opportunistic for us to do that. What helped us get here and launch in February was change in regulation, not only from the ETF rule, which we can touch on that a little bit, but the ETF rule allowed for issuers to come to market in a more efficient way, allowing them to take advantage of opportunities that weren't existing prior to the ETF rule, like custom baskets, negotiated baskets, to be able to support tax management of those ETFs. And I think our previous panel touched a little bit on that as well. But those are some of the considerations, was the regulatory side. But then there are other opportunities to come to market. We are transparent. We're fully transparent, which means we provide our holdings on a daily basis. But there are now opportunities to bring products to market in a non-transparent manner and a semi-transparent manner as well. So some of those opportunities are through Presidian. The New York Stock Exchange has its own solution. The T. Rowe has their solution. Fidelity, Blue Tractor, and I'm sure I'm missing a few, that allow you to bring products to market in a semi-transparent manner. So this has opened up the opportunity for a lot of issuers to say, how can I now bring my products to market, utilize the tax efficiency that this ETF vehicle allowed for in the passive structure, and how can I do that either in a transparent or a complete transparent or a semi-transparent manner? that was one of the biggest deciding factors for us, was to be able to utilize, as we looked at the types of products, the strategies we wanted to bring to market. We were comfortable being able to do that in a transparent manner and take advantage of those efficiencies that come with that ETF rule for tax management.
Yeah. So you hit on, I think, a few good pieces there. One, obviously, multiple paths to market entry have emerged in terms of structure choice, right, and having flexibility in terms of disclosure, which we recognize is an important thing for an active manager. You know, regulatory changes, obviously, streamlining process. You know, maybe Shana, a little bit different view, as you already articulated, kind of in introducing yourself. You know, from your shoes, what do you see out as some of the trends that are really driving the growth of the market, and how are those different from the things that have already been brought forth?
Well, I think one of the biggest trends you see now is that the barriers to entry into launching ETFs are low. You know, whether it be any of the organizations that Scott just mentioned, or working with Title Tarosso or Alpha Architect, the barriers to entry and the cost to launching an ETF is low. I think as allocators out there are looking for products that are vehicle agnostic, is how I like to put it, where they can be able to use an ETF, a mutual fund, a commingled product, an SMA, across the different types of clients they have. At Corrales, we have our underlying proprietary models, in which 80–85% is ETFs, both active, passive. We're cognizant of fees, but one of the things we like is to have vehicle agnostic options, so that we're not changing our underlying models for clients that are larger. So we like to be able to have an active ETF with a low fee, while also being able to offer some of our larger clients the ability to get an SMA of the same product. So everything is cohesive across the board. And you're seeing more and more of that. One of the trends I've definitely seen is the larger firms, the Fidelities, the Cap Groups, the Putnams, the T. Rowe's, are taking some of their more popular, larger cap, liquid products and converting them into ETFs and gathering assets pretty quickly, because these are already popular, well-known strategies being offered in a more tax-efficient, cheaper wrapper. But you're seeing a lot of smaller firms launching unique niche product. And that's interesting to me, because historically those are either Cathie Wood ARCs or crash and burn and liquidation. And you see it a lot in sort of niche areas like liquid alternatives, which I spend a lot of time in. And it's frustrating because those products, if they're not sponsored by a large firm, tend to, even if they're really good, not last very long, because they just don't have the background to go out and market and gather assets, which is why firms like Title Tarosso and Alpha Architect have become so important to those smaller issuers. So as far as trends go, definitely seeing a lot more active ETFs being launched, not just by the big providers, but also smaller firms, because there are resources to do it. But more importantly, the current market conditions kind of lend themselves to people wanting to look more active. And the debate about active or passive, no longer are you doing ETFs versus mutual funds. It's actually looking at the underlying product investment process that's being implemented. And so the lines have kind of skewed, and it's harder to kind of garner what's going into active and passive, because the way that it's typically been done has been ETFs versus mutual funds in that sense. But I have a feeling that going forward, especially as things continue to be as they are, more and more people are going to be looking into active ETFs as a solution for their clients in difficult markets.
Yeah, no, that makes a lot of sense. And you mentioned a few things there that I really like. Wrapper agnostic is a term that we hear often, right, as we're having conversations with large asset managers, but even smaller asset managers that are looking at kind of building out a lineup, or a wealth manager who's considering doing a conversion from an SMA into an ETF, because of some of the benefits that come with the structure itself and some of the access associated with it as well. And so that's definitely a trend that we're seeing, and we're seeing it a lot on the active side. kind of the last plug I'll make in terms of stats, then I'll kind of stop and let my panelists kind of take it from there, is what we actually saw last year. We did some analysis. We have a newsletter that comes out every month. You can see it at homeofetfs.com. And we looked at cash flow by kind of issuer. And the trend that you see obviously indexing is that the top of the top are really winning the cash flow war. And that's something that we've seen for a while, and it's been really hard to compete on the bottom end. In the active market, it's actually a different story, right? You're seeing smaller firms come in and have success. And so, as I think about having a healthy marketplace, that's one thing that we're really interested in ensuring. Obviously, we have some big firms up here today. We want to support them, and we value what they do in the industry. But having that broader set of products to choose from, I think, is really, really important. So maybe moving in the direction of talking about product and product design. Michael, I'd love to hear from you in terms of Putnam new to market. Scott referenced it. You guys went the path of semi-transparent. Would love to hear your kind of thinking on product design, what led you to that kind of decision, and where you see things going from here.
Thanks, Mo. So I would just say I see a couple of our distribution folks in the audience there, and they'll tell you the best product development we do is the kind where we get the hell out of the way as fast as possible. And we've heard a lot of people talking today about the challenges in getting from 0 to 100 million, 200 million, whatever the number is you're shooting for. And for us, I think to look back on one of our most successful new product plays in the past few years, it was 2018, we repositioned a struggling fund as a short duration bond product. We fixed the pricing, it needed a little bit of help, but the moment we repositioned that product, it was available everywhere that we sell our products. It had $100 million plus in assets, and all of our distribution folks already knew what conversations to have. So we accelerated from the lab, somebody else mentioned the lab earlier, to our salespeople actually being able to have conversations immediately. And that's where we like to live. And this is not where we're living now. When we entered the active ETF space, I think we probably appreciated, but maybe still a little underestimated, what a climb it is to get from 0 to 50 to $100 million. It's incredibly challenging, and it's a muscle that we haven't flexed without the support of repositioned funds with availability and assets in a long time. So I think just from a product distribution perspective, what we see as the trend to get matching that supply and demand is not so much going and finding ETF buyers and converting them to active ETF buyers. Because you're talking about somebody who's used to spreads, in the single digits of basis points and used to volumes in the tens of thousands or hundreds of thousands, and telling them, hey, come buy my ETF that's new, and it's, we're working on the spreads, we're working on the volumes. But if instead we can bring along people who are already buyers of the Putnam story and say, hey, you buy the fund, let's get you that in a more tax efficient, more cost efficient way. I think for us, at least in our micro kind of piece of the world, that's how we would see demand growing, because the macro trends you outlined, we all recognize them and they make a ton of sense, but that doesn't help us. We have to find a way to make the micro trends work for us. And Mo, to your question specifically about the transparency piece of it, I think, there's a reason that Putnam and other managers like Putnam haven't been in the ETF market. There's things like the ETF rule and different barriers that existed, but there's also fundamentally getting your colleagues in your investment division to say, hey, we're going to put this out here. Everything you do that you've been getting paid for and that you've built your career on is going to be available every day on our website. That's a pretty significant challenge, and I think we've seen a lot of issuers like Putnam and others in Cap Group obviously change the dynamic a little bit. Get into the ETF market, dip a toe in the water in the semi-transparent space, say, oh, the water's actually pretty nice. I kind of want to dive all the way in, and really the only way to do that across asset classes, so long as semi-transparency is limited to U.S. equities, you gotta go fully transparent, and I think we've come along on the journey, and a lot of our friends and competitors have too.
Mo, could I add one thing to that? That was really well said. I think the underpinning all of this, right, is education. Right? You mentioned how a lot of the new buyers of our ETFs are traditional mutual fund users. And believe it or not, there are a lot of people out there that still can't really understand the full scope of the ETF ecosystem, how they trade, how they operate, the creation redemption mechanism. So for all of us here today, education is still an extremely important part of the business, not only with our clients, but at our respective firms as well.
I actually, just to add to that, the education part is so critical. Creation redemption is really confusing to people. They get so focused on liquidity sometimes, and you have to explain to them, like, it's not really the liquidity of the ETF that matters, it's the liquidity of the underlying that matters. The other big thing that people completely overlook when looking at active ETFs, and I really think needs to be part of the conversation when you're considering investing in one, is the lack of ability to handle capacity constraint. We've seen this a little bit with ARC, but you can't close an ETF. So if you're going to launch an active ETF, you need to make sure it's a product that, if you are blessed enough to gather immense amounts of assets, it is the kind of product that can handle and has capacity for a large amount of assets. You cannot close one. So I don't foresee an environment where you'll see a lot of launching of small cap active ETFs or things of that nature, just because capacity is one of those things that's an important part of the investment decision for a manager, and you don't want to have, and we've seen it, and I hate to just keep picking on Kathy, but she's such a high-profile example. If you're very concentrated and completely transparent and you got assets, all of a sudden people start following your trades, they can front run you, they know what you're doing in real time, and if you got your assets all in one flow, it really can move the market and hurt your product in a big way.
Yeah, I think capacity is a point that we often talk about with a number of folks, and in my prior life working at Vanguard, something that we talked a lot about in terms of thinking about strategies as well. I think it is something we probably should spend a little bit more time talking about. I'm sure, Chris, it seems like you have an opinion. Michael, I'd love your opinion. Scott, as being a head of capital markets and thinking about the tradability of the underlyings, you also have to have opinion, so I don't know who wants to go, but take it and run.
I can jump in. And T. Rowe Price, obviously, $1 trillion asset manager, very well-established, well-known shop by many, both individual and institutional investors. When it came to bringing new product to market, we brought them through, as Scott and Mo mentioned, through the semi-transparent structure. We brought to market 5 kind of well-known, we call flagship strategies. So blue chip growth, that's been around decades. Our dividend income fund that's been around for 40 years or so, and is associated to a lot of assets, right, in other vehicles. So the mutual fund, hundreds of billions of dollars in mutual fund, SMA, CIT assets within those respective strategies. So when it came to launching in the semi-transparent space, it really was from a good place, right? It was really centered around existing shareholders in our other strategies with capacity in mind, right? We get the question, well, why aren't you launching your New Horizons fund or your New Era fund? Well, it doesn't fit the structure or SEC rules, for that matter, in some respects, of what we can launch in semi-transparent active equity. So it's really coming from a good place when it comes from product development in the strategy we bring to market, focused around capacity, focused around turnover, and how we can actually really, I guess, create a better experience for our investors, both in the ETF, but also the SMA and the mutual fund, when we're exiting and entering positions that, it could take several trading days to produce, a new position. So we want to make sure that it's in the best interest of our shareholders and our clients. And when we tell this to clients, right, when we tell this to investors, they get it. They say, yeah, absolutely, that makes perfect sense. The structure makes sense. And we deviate away from the semi-transparent active category and the mechanics behind it to that, this is an ETF now. This is a way to access blue chip growth in a more tax-efficient, scalable vehicle than I've been previously doing in the mutual fund or SMA.
Michael, Scott, anything to add to that?
No, I think you hit it right there. From a product design, we have to understand what is the strategy we're trying to bring to market and what are those risks for our shareholders. Again, our ETFs that we brought to market, we did not clone. So they're new strategies, complementary to our mutual fund. So as we looked at product design, especially for our first suite, we were looking at what are our current vehicles, where are those needs that we're hearing from our advisor community, and how do we fill those gaps with complementary products. So we have not converted one fund. All of our assets to date have come from organic growth into those products. We did transparent, but that's also because we looked at what are we trying to achieve. We're not cloning, so we're not trying to protect other strategies that we're running in line with that. We looked at the underlying liquidity of the securities and the companies that we're going to be holding in these funds, and how well would we be able to trade to our convictions. So a lot of thought went into that, and I think as issuers are coming to market, they are being mindful of capacity and the type of strategies that they want to bring to market, and looking at the semi-transparent, non-transparent wrappers to be able to achieve that.
I think, in talking about excuse me, product design and thinking about what asset classes and what types of products might work in the ETF wrapper, especially when we're talking about more capacity constrained or more esoteric asset classes, there's two questions really that we think of. One is the capacity constraint issue, that you can't turn this off, and what is your total capacity? And then the other is spreads. Ultimately, what's the liquidity of the ETF itself going to look like? And on that first point, I think the good thing about that is it's pushed us to be more creative, and obviously, folks, if they go on their Bloomberg, can see which ETFs we have in market, and they're plain vanilla, big bucket, but hopefully not that way forever. But I think that the overall liquidity or the capacity constraints have forced us to think more creatively, that maybe, hey, this asset class alone isn't going to work necessarily in an ETF, because we would have to find a way to shut it off, and obviously it's complicated. But maybe that, as complemented by another asset class, thinking about the end portfolio goal rather than purely the asset class, is a thoughtful way of going about that, and it forces us to be a little bit better and a little more creative. And I think the second piece on the actual ETF liquidity, it's just, that comes down to education for us, and it's going to be a challenge, as I said earlier, to unseat people's thinking as passive ETF investors on what's a reasonable spread for this asset class. But it is incumbent upon us to make sure that clients understand you're not buying a passive product. You already are accepting that you're buying something active in your total expense ratio and your management fee. Spreads are the same way. There's a cost to being active, and if you're going to be in a small cap active ETF, your spreads are not likely to be in the single digits, and that's okay. Clients are okay paying, wider spreads. They just need to be educated up front that that's the case. So I think that's really where it comes back to us, and making sure that folks, we address what they're anchored to in a really appropriate way, in a way that we're not going to regret down the road too.
Mm-hmm. Yeah, I think that makes sense.
I will
raise your
just
hand.
put a
Yeah.
disclaimer though. Active does not mean wider spreads. Thank you, Jane Street, Virtu. That is one of the considerations, again, going into product design. Once our teams are looking at what are the right type of investment strategies we should be bringing to market, it's partnering with capital markets and our trading relationships out in the secondary market to understand what is liquidity for this product. So how liquid can this be? What should spreads look like? And that's something that we've spent a lot of time building out, that ETF ecosystem across all of our ETFs, including our fixed income. We're averaging 3-cent spreads. So how do you get there? It's looking at the basket design, having the right ecosystem, and having the right basket construction. Someone talked about earlier, your ETF is as liquid as that underlying basket. So building that so that our market makers can price that and quote that for you as confidently as possible, so that they have the conviction of where that ETF should be trading, and having that basket at the right size so it's consumable for that market maker, that they're not carrying a lot of inventory and they can easily use this creation redemption process to meet that market demand. So I think it's just one of those things as we look at, again, different asset classes may require that you're going to see greater spreads. You may see that there's going to be greater premium and discounts, or different sizes and depth, but that's all part of that portfolio construction and consideration by issuer of what do I want to see. And at the end of the day, at least from a capital group perspective, it's about meeting our advisors' investment goals and strategies for their clients. It shouldn't be about the liquidity of the product. That we need to provide that liquidity and the confidence that they can trade in and out of our products, and really be considerate of how do you take over the core and use our funds for the core of their portfolios, and not about trading.
And I actually think that brings up a good point. As somebody who's more of like an allocator and a practitioner using these products, what is really unique when you are working in an ETF, that the underlying is pretty liquid, but the fund shares of the ETF itself may not have a lot of liquidity. So we actually invest in two funds that kind of fall into this bucket. We invest in the FRDM fund, which is the Freedom, Life and Liberty Freedom Index. It's only about 100 million in AUM, and then we also invest in the BTAL AGFIQ U.S. Equity Market Neutral Anti-Beta Fund, very long name, which is also around 100 million. And one of the unique things about ETFs that is not true in the case of mutual funds is, in the case of FRDM, we knew it was going to be a difficult trade. We were putting, $10 million into this fund. So we were able to call GTS and work directly with the market maker to be able to do that trade in a way that wasn't going to be disruptive to the market, to the underlying securities, or to the fund itself. And the same thing with BTAL. We worked with Fidelity's capital market desk to do that trade for us. That is not something you can necessarily do with mutual funds. It's a different experience. And so as a user of ETFs, the ability to work with the market makers or cap market desks to do these trades in a way to ensure best execution for your clients is one of the reasons that ETFs are more favorable in a lot of cases, especially when you're working in an area where you're not dealing with massive asset bases.
No, I think that makes a lot of sense. And two things. One, I love how Scott raises his hand when he wants to participate. That's very kind of him. Two, I'm glad he moved the direction of the conversation towards liquidity, because it is something that comes up all the time. Michael references well as part of conversations that we're having and we're hearing that our clients are having with their clients, right? And so I think that there is some myths that still exist, and education is a key component piece of that, as we've already talked about. But I'd love to kind of shift towards that client side, right? So things that you each are kind of hearing from your clients consistently as you're kind of getting out in market. And maybe, Michael, I'll start with you. You referenced distribution earlier, and some of your folks that are here today. What have you guys been hearing from your clients as you're going out and having conversations, and what are the things that you want to do moving forward?
So I think, Mo, in good development for you, the thing that we haven't heard that I think we were expecting to hear a lot more of was about the wrapper itself. So our first 4 active ETFs are all semi-transparent, and I think we were expecting a much more uphill climb on that piece of it. And obviously, the largest broker-dealers are still working through, a lot of questions related to semi-transparency, especially around cloned products, and so still plenty to do there. But at the actual financial advisor level, I think we've been surprised to hear less of that than we expected. Now, we're still having all of the, hey, this is a new fund, you're getting up and running, all those conversations, and those have their own challenges. But I think that was one thing that's really surprised us. Now, for us, the game, and I think like a lot of asset managers, the game is about getting from the hand-to-hand combat with an RIA, with true retail investors, to getting to the folks who allocate really large amounts of money. And that's going to take a little while, because they've said to us in plenty of different cases, this is about financial advisor demand. We've got a long list of things to take care of. We've got a lot of things to do at the home office, and we're not going to be working our way through the many challenges presented by, say, clones or, say, semi-transparent products, until we see advisor level demand. And I think the good thing is we're seeing momentum in that direction, and I know that our friends from T. Rowe Capital Group, for example, are helping move that conversation along, because people can't ignore when players like that enter the market. So I think that's been really what we've been surprised by on the upside, and I think what we're hearing is just a lot of, this is great. We're happy to see a strategy that we already like in a lower cost, more tax efficient wrapper, and just kind of getting into true sales conversations at the investment strategy level, which is what we want to be doing.
Yeah, that makes a lot of sense. Maybe Shana, I'll just kind of continue down the line. Obviously, you referenced a few times difference in multiple vantage points in terms of how you think about things, but maybe as an allocator, right? Like, what do you hear there, and how you think about portfolio construction utilizing active, and then you put your consultant hat on, right? What are you hearing from folks that you're working with?
So as an allocator, I already mentioned this, I'm sort of vehicle agnostic, and we actually, if we're gonna do active, we wanna do it in places that make sense. We wanna do it in places that have multiple different vehicle options, so that we can have continuity across portfolios depending on the client type. For us, that means we wanna see active ETF active mutual fund for our defined contribution clients, and because ETFs are not necessarily readily available in 401k platforms, and also SMA options. So again, we can have continuity across that. So that's really important to us. But in terms of, as the consultant, when we did the launch of House for Armada ETFs, the number one thing, surprisingly didn't run into a lot of, well, this is a new fund, we need your track record. I feel like because it's an ETF, you don't hear that as much as you do with mutual funds, where all of a sudden they become obsessed about who's the manager and what's the track record. For whatever reason, the sense is, if it's in an ETF, it doesn't need a track record, which is strange to me because it should, especially an active ETF that's not being hung off an existing product. But I don't feel like that was the number one thing we heard. It really, the questions that we consistently got as we went out and marketed the product had to do with liquidity, what is the current asset base, how hard is it going to be to get in and out of this product, who's your market maker. Those were the number one concerns we were really dealing with House. And we were able to address them. That House did not launch with seed money, and that was on purpose. The CEO of the firm really didn't want to have a seed investor until he had some track record, and he felt like it was gaining traction. But that meant that we had to do a lot more discussion about liquidity, ability to trade shares, and the create redeem process, and work really closely with our market maker and get them on client calls to be able to address those. But those have been the main areas, from both vantage points that I've really seen client questions come from. And it seems so repetitive. We keep talking about the liquidity aspect of it, but it really is the number one thing. The creation redemption process is just very difficult, I think, for people to wrap their head around. We've spent all these years as allocators focusing on these mutual funds, talking about like liquidity and ability to trade, and how do you make sure that, how fast can you get out of these products? Are you not going to move the market? So ETFs intuitively don't necessarily make sense when you've spent decades having those conversations, and now you're dealing with something that has a different process to address liquidity issues.
Yeah, makes sense. Maybe, I don't know if you're going to stay on liquidity, Scott, but same question for you, right? Is you've now been in market for a few months here. What are you hearing from your clients? What are you focusing on moving forward?
Yeah, we don't really get questions about create redeem. Sometimes, the back of the house wants to really talk about how things are made and how great State Street Bank is doing for us from a custody bank, and, our different market makers, who are out there supporting our products. But I think, we're doing a very good job distribution and our relationships with our advisors of putting the right information in front of them and helping them understand, again, what is liquidity in an ETF? Every one of us has a piece out there that talks about best practices and how to best execute your trades. So I think a lot of our discussions, they're comfortable of knowing that our products have liquidity out there. I think Friday, we had some really sizable volumes, about 90 million, I think, traded across our suite. 42% of those trades were blocks. So what the conversations that we're having with some of our relationships are, number one, when I'm doing it at a client level, being able to just do a marketable limit order, what's the right time? But where we're spending most of our time is, okay, for these sizable trades, how should I work with my block desk? Or you are capital markets, what is your resource, there for us? Can you work with us, help us understand how to place that trade? What is it not held? Where do I find it on my system? So we spend a lot of time working with our different advisor relationships and our RIAs to understand their trading systems and how they would go about doing that, working with those block desks so that the advisors have that satisfactory experience when they go to trade our ETF. So it's really around that execution when they're doing smaller sizes, or if they want to do a larger trade across their book and doing average price trades or whatever it might be able to give that guidance to support that, and then help them understand how to use the resources available to them, their block desks, our capital markets, or their direct relationships with their market making relationships.
Yeah, I think that that's a great plug, excuse me, for anybody who's in ETF capital markets, right, in terms of importance of role in helping the ecosystem and facilitating that process directly with client. And so that's something that, whether big or small, is an area of continued education and focus, I think, for our industry. We've made a lot of really good progress, but it's something that remains, obviously, as new entrants come into the marketplace, is finding the individuals who have the knowledge, the understanding, and the ability to connect all the dots. But there's a really good ecosystem to help in that process. So Chris, I'm going to kind of finish up with you. Prior to even joining T. Rowe, your background was you were actually in the field selling ETFs, right? So you truly heard from clients. Now you sit in more of a specialist role. You continue to hear from them. How has that conversation evolved throughout time, and what are you hearing now?
Yeah, I'd say there's really two themes to the conversation, right? The first theme is the operational side of a practitioner's point of view of, what can ETFs add to my practice from a benefits perspective, and what that is if an advisor's been using blue chip growth mutual fund in their non-taxable accounts for the last 2 decades, and say a proxy to that, a Vanguard Russell 1000 growth ETF for their taxable money, they now can create some symmetry and similar experience between both their taxable and non-taxable clients when it comes to portfolio management. That's really important, I think, for a lot of advisors now, that consistency of experience across their book, both from an asset location perspective. So the operational efficiencies is something that I think is becoming really, really relevant and topical in these meetings. And then just the market, right? What's happening in the market right now is getting advisors and investors to think about active management, I think, more. And we have 5 ETFs on the equity side. We have 3 fixed income. They all track existing mutual fund strategies. But we've balanced our offerings pretty nicely. So we've got our growth stuff in the equity side. We've got 2, an equity income, a dividend growth. So we've got growth, we've got quality and dividend income on the equity side. And then we've got core and ultra short on the bond side. So we can kind of go both directions, especially now as the market is transitioning. I think asset allocation portfolios are starting to get back to normal from a value to growth perspective. More conversations around going to value, but then active management, right, in that exposure. So I think you're starting to see advisors realize the benefits of, one, just the ETF itself from a tax efficiency perspective and what it can add to their practice and their client's experience. And then 2, just finding active management as a really interesting entry point right now, given what's happening in the markets.
And I just want to add one thing. I know but you just brought up a great point, the ETF tax efficiency. But the other thing is, as an advisor, if I'm on Schwab or Fidelity's platform, there are costs that are associated with trading mutual funds. You got to worry, is it the NTF? You got to worry about justifying why you chose a share class you did. You don't have to worry about that with ETFs at all. Yeah. The trading and the cost of trading is much different, and from a compliance standpoint, it's so much easier to have the ETF.
I'll share a story with that. And just recently, last week, a client that uses our ultra short mutual fund, they have to hold that for 90 days. So think about an ultra short position that might be used as a de-risking or cash alternative or solution. You have to hold that for 90. I mean, it doesn't mean you can't sell it. That just means you're rather restricted to ever buy it again. The conversation was just simple. You can buy our ETF, commission free. You can trade it intraday. So as we know, ultra short is a great solution for cash management, liquidity management, and just the flaws of the mutual fund structure allow ETFs to really take market share. And again, in the best interest of the client, provide efficiencies for the client, right? Which is solving a problem, which is what we're trying to do. So, yeah, it's a great point.
Yeah, it's a really good point. So we're at about 10 minutes. I want to make sure that we allow, if there's some questions from the audience for the panelists, that we get those in now. See one over here?
Thanks. Kind of 2-part question. The first is, what steps are you taking specifically for active ETFs with market makers to make sure that they're comfortable with the risk profile that you're sending them, particularly if you have derivatives in your strategies? And the second is, as you build out your suite of active ETFs internally, what are the kind of the pain points for scaling your firm and your capabilities, and how are you addressing those?
Who would like to start?
I can start with the scaling aspect since I'm this person who worked with the small guy. In
We have those challenges too.
fair enough, but you have the resources kind of already there. With the smaller firms and scaling, it really just becomes about efficient use of resources that you have. And I mentioned this before, and I'll mention it again. Organizations like Alpha Architect and Title Turoso really, really help you in building your product and helping you scale. Providing you all the services you need, making sure you have everything from marketing support to compliance support to operational support, working directly and making recommendations on the market making side, and then working directly with your market makers. I've had the pleasure of working with both GTS and Jane Street over the years, and they are an instrumental part of the entire process when it comes to making sure that your product and the structure and everything is scalable, and that people who want to buy your product can and have access to capital market desks and market makers. So from a scaling perspective, I think this low barriers to entry and these service providers that kind of help with the process of launching a product really help on the smaller side. So that's kind of my perspective from that standpoint. As far as the derivatives and working with your market maker, I haven't worked with a fund that was a heavy user of derivatives, but I do invest in a lot of liquid alts through ETFs where it's possible, because not all liquid alt strategies can ever be done in an ETF. And the changes to the 40 Act have some limitations there, which makes it a bit easier to sort of manage some of the complexities of those types of products, and a good market maker and good custodial relationship can really help with that as well.
I could touch on scaling real quick. Larger broker-dealer platforms are starting to get around at least the semi-transparent active structure, right? So we're starting to see approvals happen there. That's obviously extremely important. We've had really good progress in the RIA space, but you really need that next engine of growth to happen from the broker-dealer distribution platforms, right? And then the other element, which is critical, is model portfolios, right? How do we start to work in utilizing T. Rowe Price's multi-asset team, which is very well established from our target date series? How do we start to get them comfortable? Believe it or not, like getting them comfortable with using ETFs is a sales job for us, right? We need to get them up to speed on how to trade, how to build model portfolios using ETFs, and that, as everybody knows here, adds a ton of scale, right? If you can get model portfolios on different platforms via TAMPs, broker dealers, et cetera, provides tremendous scale.
And just to kind of echo that, I think knowing your firm is really important, because getting to whatever that number is, it's $100 million, let's say, by hook or by crook, but understanding what that looks like for you. So is that, you've got a great model portfolio platform, and maybe that's an opportunity where with a really hard sell, maybe the barriers to entry are just a little bit lower. Do you have affiliated wealth management? Do you have great relationships with, as a really specific list of people who have been saying to that, wholesaler in territory, whatever, for years, I'd love to buy it, I need the ETF. Have that list and think about what does that look like for you, and then doing everything you can to get to whatever that picture of scale is for you. And the other thing is, this is more of an internal view, because that nobody lets me talk to clients except today. But it's really understanding what expectations are realistic, because as I said earlier, the last really great product success story I can think of for us is a repositioning of a fund that had a really nice little hockey stick shape to it, because we didn't have a ton of boxes to check. And so people get used to that, and they say, oh, great product idea, this is exactly what it looks like. But a totally new business for a firm that's got hundreds of billions of dollars of assets and is used to certain things happening certain ways, the expectations piece of it is crucial.
Scott, anything you want to add on liquidity? You good? Okay. We have 5 more minutes, so maybe one last question from the audience. There's got to be somebody who has a question.
Hey, Mo.
All right, perfect.
Just going back to a little earlier in the panel, the discussions around the difficulties in closing down an active strategy in an ETF. Obviously, on the distribution side, we can do that, but there's a much bigger ecosystem out there that is of concern. Is there any hope or possibility through relief or a rule change that we could see a world one day where an ETF has the ability to temporarily halt creations, sort of getting into the world of a closed-end fund, but continue to allow for redemptions so that you can mitigate the flows into an active ETF?
Could it happen? Yes. Sort of defeats the purpose of the ETF, though. You know what I'm saying? Like, people don't buy ETFs thinking they're going to close. The whole benefit of the ETF is that liquidity, the easy to trade, and not having to worry about that. So could it happen? Yes. I think it wouldn't be necessarily good for the growth of the industry, though.
Yeah, I think if it all of a sudden turned into a closed-end fund, right, then you wouldn't be realizing the benefits of the creation redemption process, right, which is the... Go ahead.
Yeah. So maybe I'll just touch. So we could stop creates today on our ETF, but I think what we're starting to say is what is the impact to that? The confidence for you as an advisor using our ETFs, knowing that very quickly these ETFs could trade at very high premiums or discounts is something that we don't want to encounter, you don't want to encounter. So that opportunity is there, and we've seen that across different exchange-traded products over the years. There's been a couple over the last month who had to make that decision, and you can see the impact to the trading in the ETF. So it's there, the opportunity for an issuer to do that, but that's where it comes back to product design and the impact to that. I think there would be a huge impact to our advisor community if we made that decision, and they would see the disconnect of their ETF market price versus their NAV for that fund.
Thank you. Just a quick follow-on comment. Just really thinking about on the creation side, right, and recognizing that is absolutely true, coupled with education and the continued evolution of this industry. If it's an impediment, there's a potential opportunity where we could achieve that gap and educate to it with the proper disclosures on websites and things of that nature. And if actors on the distribution side in the marketplace are willing to be highly engaged, we could potentially mitigate that, right? So you never want to shut down redemptions. That is where the big allergies come from a premium discount standpoint. But it happens on the mutual fund side where gates can come up to take money in. I would love to have that discussion more, throughout the industry. Maybe there is a way that we could overcome that.
Yeah, I would say, obviously as an exchange, very interested in anything that's innovative, right, and allows for product structures to continue to benefit from whether it's consistent liquidity, obviously that comes with ETFs, or if it's closed-end funds, right? So I think there's hybrid structures there that are hypotheticals, and so we're all ears on ideas. Obviously, Greg and I have talked about this before,
and
but...
I just want to say, I know sometimes we want to make everything work in certain structures, but I think it's okay to admit that certain products, certain strategies, certain types of investment process and types of investments just shouldn't be in certain wrappers. Period. End of story. And I don't think we need to make everything one size fits all.
Well, perfect. So I think with that... Oh. Yeah. Shocking. Well, excellent. I think with that, we've actually wrapped on time. So join me in thanking